All right. Good afternoon, everybody. Thank you for your patience as we let everybody enter into the webinar today. My name is Jason DeBono, Vice President of NewView Trust Company, and today we're going to be talking and walking through the CARES Act of 2020. It's the Coronavirus Aid and Economic Relief Act. But the acronym is CARES, a heck of a lot easier to say and less of a tongue twister. Obviously, this is being done via webinar, as there's lots of things that we're all being impacted on, and certainly live classes and education is one of those. So we're going to talk today about really specifically to the CARES Act. I know there's lots of questions, and our team here has been fielding lots and lots of questions about what's going on, what does the world look like, during, post, and what, from an investment standpoint, what do I do with what I own? And I just want to kind of get out of the way. That's not really the purpose of today. I understand you guys have questions about that stuff. We have a lot of the same questions. Excuse me, and we're working through, putting together continued educational content over the coming month, culminating with a big event on May the 7th. I would encourage you, if you have questions around your investments, while we're not advisors or fiduciaries to your account, we certainly can tell you what we're seeing in the marketplace, which I think is probably a good first slide for us to get to. I'm going to assume most everybody on today is a client. If you're not a client, it still impacts you as it relates to retirement money. Nothing that we're talking about is unique to self-direction today. Everything we're talking about is unique to retirement accounts in general, so we'll talk in some broad terms. We are not attorneys, CPAs, financial advisors. We can talk about what the rules are, but its application to you specifically may be different from the person sitting next to you or on this call as well. So be sure to consult with your advisors. The other thing I want to make sure to put out there is, we haven't all had a ton of time to digest what's been provided. Obviously, everything's moving at rapid speed. So, don't quote us on everything here as fact. We're passing this on under the best of our abilities to share the information. Some of this stuff is very hot off the press, and there's even some behind-the-scenes stuff that, while they may have said this is what happens as a custodian, there's also reporting requirements and things that we do that you may not be familiar with that really haven't been finalized yet. So we're all still working through this together. It is fluid, meaning it's ever-changing. So please be sure as you go through this process today not to rely on anything as 100% fact. That's the way it's going to be. But this should be a good guidepost and good overview of what the CARES Act really means. And we'll talk about some of this stuff as opportunity, some of this stuff may be necessity, right, depending on where you fall and how your life is impacted. So we'll walk through all of that today. If you do have any questions at all, I would ask that you use, I'm looking back to make sure I get the right term, it's the Q&A section. There is a chat function, but it's a little bit easier if you do it under the Q&A. So if you do have questions, please just click that Q&A button on your little nav bar there. You can type that question in. I'll be able to open it up, see it, and read those aloud. I would encourage questions. We'll answer every question that we know the answer to, and we'll defer you on the stuff that we may not have a clear answer for you on. But please keep those questions coming in and give us a chance to understand the types of things you want to make sure we cover today. As far as NewView goes, for those, our job is to be a custodian, in this process. We are still operational. We are an essential business. We take the fact that we hold your money seriously. That's important for you. It's certainly important for us. We'll talk about some of the things we've instituted in our company here to make sure that we're keeping ourselves as safe, as possible and our team members through this process. We have canceled all live education, as you can suspect. We did that even prior to any sort of shutdowns in any of the states. We grounded our entire sales team and marketing team from travel and events. We try to be as out front as possible in this process to ensure that we weren't taking any unneeded risks. We, at this point, our office, our operational office for NewView IRA in Longwood is not taking on any visitors. So we do have a drop box there. So in the past, people walked in and filled out paperwork or dropped stuff off. Obviously, we're doing all that through a drop box. We are pretty close to capacity, meaning our normal staff, as you can imagine, we do have people that have childcare and other reasons to be out of the office, so there is some impact being felt there. But we are very close to being fully operational, and I share that because I want you guys to know that, for those that are clients, it is still in our world business as usual for what you're looking to accomplish. So we currently are not experiencing any slowdown in the services we're provided. That certainly could change tomorrow as depending on our staffing levels and people coming and going. But as of today, we're processing on a real-time basis as we would pre-COVID. We're continuing to do things in our office, taking the feedback from our team. We've been taking temperatures of our office now for over 3 weeks before people came in. We've instituted quite a few things internally. We're not having any meetings in our office of more than 5 to 7 people. We're keeping social distance, and any sort of meetings that may transpire, we're using internal precautions. All the things that you would suspect, and hopefully a little bit more as we continue to navigate through this kind of unprecedented time in all of our lives, to make sure that everybody here is as safe as possible, and most importantly, and it's going to allow us to continue servicing your accounts as we go through this. So as we move forward, let's talk a little bit about the CARES Act, and this is kind of broken down into items as it relates to impact. So I want to start with tax filing. Now, I am not talking about all of your tax filings on an individual basis. I don't know what those are, corporate, et cetera, but I can tell you this. The CARES Act did extend the tax filing deadline, which was originally set for April 15th, to July the 15th. Now, as a result of that, it also extends contribution deadlines. So if you were planning on making an IRA contribution prior to the deadline, you now have until the new deadline, which is July 15th. That's a pretty good opportunity. It just gives you a little bit more time. Again, not knowing where the economy is or headed or how it's impacting you personally today, but there may be some opportunity there. Excess contributions, if you're making any corrections, a lot of those corrections have also been granted an extension as well. It's not universal, so if there's some questions on a potential correction, make sure you let us know and we can kind of determine if it's something that can be corrected after the original April 15th date. But this really just pushes the deadline down 3 months, right, May, June, July, for everyone to make their contributions as well as to actually file their taxes. I understand people are still filing. I don't know if there's a delay or if refunds are still being issued. That really doesn't impact us, but you're not required to wait till the 15th, but it's optional if you choose to. The area that's a little bit more impacted that I think is very important for everyone to be well aware of has to do with mandatory distributions. Now, when we say mandatory distributions, that means at certain points in your IRA or retirement account life, you're going to be told you have to remove money. Those 2 times are once you reach age 70 and a half, or starting this year, age 72. So there's a little bit of a weird period there where you may be over 70 and a half, but not actually be required to take it because you don't fall into the category till 72. If you are currently responsible to take an RMD, so what that means would be you turn 70 and a half in 2019, right? And you get till April 1st of the following year, which would be April 1st of this year, to take your first RMD. If you're already taking RMDs, your 2019 RMD would have been due December 31st, 2019. It's not impacted. If you missed that deadline, you've missed the deadline. There's been no reprieval on that. But if it was your first RMD, meaning you turned 70 and a half in 2019, then your first RMD is actually due April 1st of 2020. If you have not taken that yet, you are eligible to forego that for 2020. You will be required to take it again in 2021 as your first RMD by April 1st, and then you'll have to actually take another RMD in the same year, not because you're required to take 2, but because your first one was technically your 2019 RMD, and then you have your 2021 RMD. The 2020 RMD was suspended if it was your first year RMD due April 1st. If you're already taking RMDs, meaning you would be over 71 and a half, and you have a regular RMD due every year by 12/31, your RMD for 2020 has been waived. right? It has been waived, which is really cool. There are some questions being asked of if you had a first-year RMD that was due April 1st, but you took it January 20th, can you put it back in and get the extension of the RMD? We do not have a firm answer on that. I would encourage you, if you fall into that camp, it's a small group of people, you may want to talk to your tax advisor and see what comes out in relation to that. The second time you're going to be forced to take money out of your retirement account is if you inherit an IRA. Now, there's been some tax law changes to that as well that are not related to CARES. They were made prior to that, and it allows for RMD's distributions to be taken over a 5-year period. It eliminates that ability to stretch an IRA over your lifetime, right? And it moves it to to 5 years. If you are currently in a 5-year distribution window, you do not have to take this year's RMD, right? Now, what does that mean? From what we understand, if you are currently on taking an annual distribution over your life expectancy, which means you inherited the account in years prior and you made that election, your distribution is not required. You will basically move on to your RMD starting next year, or back on track for your RMDs. Excuse me. If you are currently in the 5th year of a 5-year distribution window in 2020, you're getting an extra year. We haven't quite gotten the information on if you are in your 2nd year or 3rd year, does the whole distribution extend out to 6 years? We don't believe so, but we're not 100% certain on that. So it can be a tad bit confusing, but just understand no matter where you are in your RMD process or a death distribution, you will not be required to take money out for 2020. I'll pause there. If there's any questions, we can get some water now. It would be a good time to ask those. All right, continuing to move on. 401k loans. Now, there are really a couple scenarios in which 401k loans can be applicable. One would be if you are covered under our solo 401k plan, meaning you have adopted our 401k plan, then there is an option on there to add loans, that loans are available. If you have that plan, that would be one. Or you're covered under an employer plan. So this would be something you'd have to talk to your own employer about as to whether or not the plan does allow loans. Most do. But this provision allows 401k loans, right, some reprieval to those. Again, we're going to talk in context on those. So the first piece of that is when you have a 401k loan, originally the 401k loans are up to 50% or $50,000, the lesser of the two. What the CARES Act has done to 401k loans is it increases the amount of eligibility up to 100% and $100,000, not or. So let me give an example. Prior to the CARES Act, if I had $100,000 in my solo 401k or my employer 401k that allowed a loan, I would be eligible to take $50,000 of it, 50% of the $100,000. If I had $80,000, my maximum would be $40,000, 50% of the $80,000. If I had $500,000, my limit would be $50,000 because it's the maximum of 50% or $50,000, the lesser of the two. In the CARES Act, they are allowing that $100,000 limit to also be 100% of your money. So if you have $82,000 in your 401k today, you can take an $82,000 loan. Okay? They're not requiring you to only hold 50% of the value via a loan. So there's a lot of opportunity to take more money out. The second thing that they've done is raise the limit from 50 to 100, right? So if you have an existing loan on our plan document today, let's just say for $30,000, and you have another $40,000 in the account that you want to access, that loan can be accessed as a second loan. So you can actually have two loans, right? And you can take the money from the second loan, and actually treat it as two independent loans. The other thing that they're doing is providing a 1-year delay on any loan payments that were due between March 21st of this year to December 31st of this year. So assuming that your payments are due on the 1st, you would have already made March. You are basically getting a 1-year extension or delay on April, May, June, July, August, September, October, November, and December's payments. Now understand, you may be on a quarterly payment, which is the least amount of payments you can make back. It's the same process. So if you currently have a loan from your 401k as of March 21st, you are not required to make those loan payments. It appears as though they'll be added on to the end. So the loan that originally would have matured, February 1st of 2022 will now mature 8 months later, assuming that you forego the next 8-month payments, right? So it's being extended out through that process. So this is something that is only applicable if you have an existing loan or have a loan and intend to take the money, or have a 401k and intend to take the money out. So if you are covered under our plan, all of this applies to you. If you're covered under an IRA only, this is not applicable. If you're covered under an employer plan through your current employer, then you'll want to talk to your current employer to ensure how this applies to you. But this is what the CARES Act says 401ks are eligible for going forward. Again, if you have questions, please make sure that you're putting them in so we can get those answered for you. COVID-related distributions. Now, this is an area that we've gotten tremendous amount of questions on, and probably the reason most of you are on today's call. So the very next slide we're going to talk about is eligibility requirements, right? What does that mean to actually qualify? Because there is a qualification for this. But let's talk about what it actually does and what it is. First of all, you are eligible to distribute up to $100,000. That is an aggregate, right? And a lot of you have IRAs at multiple institutions. It's not $100,000 per institution. It is $100,000 per Social Security number, regardless of how many different places you hold accounts. The nice part about the CARES Act COVID distribution is that the premature penalty is waived. Right? So historically, if you were withdrawing money from an IRA and it was a pre-tax account, or almost any account, but there's some exceptions in a Roth, you would have a 10% penalty for your distributions. That is being waived. It's not being delayed. It's not being paid over a period of time. It just simply is eliminated. The second thing, and I think the part that probably represents the best in opportunity, if you will, if you need this and qualify, is to be able to pay the taxes over 3 years, right? So this allows you to take all the taxation and move it over a 3-year period. The other thing that it does is it allows you to move after 3 years from the day after the distribution to roll over that money back into the account and avoid the taxation. Now, there's a lot of questions about how this works on our end in terms of reporting, and in the past, there have been similar situations like this. There is a code that's generated, so when the distribution is taken, we put a code in our system under what premise it was taken, and that code goes to the IRS, and that signifies to them that this is a special purpose distribution, in this case for COVID. We haven't gotten that information yet, but that's generally how that will work. But this really gives you the ability to take that money, avoid taxation, kick the tax can down the road for 3 years, and still potentially put the money back. Okay. Now, I will just tell you, first of all, this should really only even be considered if you have financial need. Now, with every possible, whenever you open up opportunity to avoid distribution penalty and have retrieval on the tax bill, people see this as a way to go raise your IRA. And I would just caution against that for those of you that are on there. The eligibility is pretty liberal, meaning it's not hard to qualify when you kind of see what it is. So there's a lot of ways that you could technically meet the criteria. If you do meet the criteria, it doesn't mean you have to use this as an opportunity. I can't tell you what money to spend first. I don't know what your financial situation looks like, and I understand everybody is dealing with this in much different areas, and there's a lot of people that have been laid off of work, and this is exactly who this is here to solve, right? It's a real problem, and this, in my opinion, is a real solution. But that said, there's a lot of people that will see this as a way to go tap into some money. Just be very careful doing that. You know, you want to make sure that if you can, you get it put back into the account, know what the rules are, understand what it takes to get it put back. Because what people think is that if they avoid the 10% penalty and they take the money personally and they can kick the tax can down the road, it's a good deal. What they don't think about is all the money that earns is yours personally. So if you're going to use it to go make investments and you earn money, right, and you take money out and go buy stocks because you think they're on sale, you're buying them with your personal money. So any gains go to you personally, which in some ways is good, but the gains on those investments is taxable to you. So be careful. If your goal is to simply, make money on this money because you see opportunity, 99 out of 100 times, if you don't have the financial issues of needing the funds, you're better off leaving it in the retirement account and buying and selling and keeping those gains inside the retirement account, tax-free or tax-deferred. The clients self-certify, right? So we are not the police, the judge and jury, or the IRS. So when you call us, you don't need to tell us why or explain to us or provide letters. We have added this already. It's on our website today. If you go and pull our distribution form or you log into your client portal and make a distribution request online, it is there, and there is an option under the type of distribution, and I believe it's listed as a COVID distribution. So you can check that box. We will report it as such, but it's up to you to certify that you qualify. We have no review process for this. I'm not telling you that so that you feel like you can just simply say it and it becomes true. It just means that it's between you and the IRS as to whether or not you actually qualified for that distribution. Now, what their review and policing mechanism is going to be, I don't know, but that self-certification requires you to have some sort of validation or proof, and I always recommend if you're going to self-certify for something that you document that in some way, shape, or form, even if it's something that you put in your file or something that you give to your accountant or something that you notate so you never have to worry about whether or not you met the criteria. Let me pause there before I get to eligibility. Let me answer looks like we've got a question that's come in. And the question says, if you are in RMD cycle and you miss a distribution but filed your taxes on time and filed that you took your distribution but didn't know you actually took it, do you need to file the tax form for the year you missed that states you actually missed your distribution? However, you already paid the tax on the distribution you really didn't take. Whew. All right, well, I think I read that accurately, and thank you for the question. First of all, I'm going to start by saying that is way more of a tax accountant level question than anything. I'll answer that in my understanding of having seen stuff missed. If you missed your RMD but reported that you took it, in most cases, the IRS will know that to be false, because when we process an RMD or a distribution, we report that to the IRS. So if you didn't take it, no custodian has reported that on your behalf. So from a checks and balance system, the IRS says, client A says they took out $5,000, but there's nothing over here that's going to match, and it's going to put up a red flag. So it's going to be pretty easy for them to know. The second thing is, if you paid the tax for not taking the distribution, how did you do that? I would be curious as to how you paid that tax and how did you report that you paid that tax. From my experience, most of the time when there's stuff missed or stuff filed erroneously, it's almost always best to go back and do a modified, your tax return for the previous year. It happens all the time. I've done it multiple times in my own life, having missed items or things, and it's a pretty easy process. But I would suggest looking into that. I'm a firm believer if you're doing the right things, to let them know. You never want to give them a reason to think you're not doing the right things. Spreading out the taxation on a distribution, can you pay the tax only in the final year? It's my understanding, yes, but please don't quote me on that. But it appears as though you have up to 3 years to pay the taxes due on that. And I don't know if that gives you the ability to time it, where you wait or you can pay it in any particular year. But I think what they're trying to do is just give you a window to know that if you do it, you're not going to have the tax burden right away of that distribution. I don't know, candidly, how that's going to be handled reportedly, from a standpoint of what we do. At some point, we can only tell the IRS via 1099 that you took out X amount of money under the COVID exemption. How you're going to file that annually, if you're going to have to notate each year that you are not paying the taxes, or are you paying some of the taxes. The other reason why, it is because you can still do the rollover in that 3-year window, and so that's what likely means you don't have to pay it till the end, so that if you do intend to roll it back and not have the taxes due, you wouldn't have already paid them. Otherwise, you got to go amend a return and try to move that previous tax payment forward. So there's a little bit of uncertainty there, but yes, the opportunity, so far as I understand it, is it's due within a 3-year window. It says, I have a traditional self-directed IRA with NewView. Am I eligible for that 100% withdrawal without penalty? So I'm going to get to the eligibility of that. I'm so sorry, there's a second question to that. I guess let me start with that question, even though you've modified it. If you have an IRA with us, that doesn't create eligibility for this COVID withdrawal. What creates the penalty-free COVID withdrawal would be being eligible, and I'll talk about that on the next slide. If you are eligible, then you apply for the withdrawal no matter what type of IRA you have, whether it's self-directed or not, traditional, Roth, simple, or SEP, or whether it's held at NewView or Schwab or Fidelity. It wouldn't make a difference. None of these rules are unique to self-direction. As far as borrowing the funds, the short answer is no, you are not eligible to borrow money out of an IRA as far as a loan goes. Now, if you recall, you can take the money out and you have 3 years to put it back. Now, I don't like to call that borrowing, but if you take it and give it back, that's borrowing, right? Now, there's no interest rate, there's no payments that you're foregoing. They're two separate things. The 401k loan provisions that we talked about apply only to 401ks. They are actually a written declared loan. There are payment terms, and those payment terms will have to be met starting January 1st of 2021. So if you take out a $100,000 loan over a 5-year, which is the maximum amount of time, unless it's for purchase of a first home, or sorry, not a first home, a primary residence. If you have a 5-year loan, this doesn't impact years 2 through 5. It just says your first year's payments, or in theory up to the end of this year, are not required to be made. But the loan itself is still a loan with repayment requirements. When we talk about IRA distributions, those are not loans. There are no prepayment terms. You take the money out, it's reported as your money, it is filed as you have taken it out. You have up to 3 years to put it back or pay the taxes due. So technically, it can be a 3-year loan, but whatever you do with the money during that time, it's your money. And by the end of year 3, right, the date after the day in which you took it out 3 years later, if you haven't put the money back, it is fully taxable in that tax year to you, assuming you haven't already paid it. So just be careful in that process that you don't set yourself up for a large tax bill. Is an IRA to Roth conversion considered a CRD, which is the corona-related distribution? I wish that would be opportunistic. Unfortunately, it is not. If you do a Roth conversion this year, it is taxable this year. So you would have to have the tax bill due on your 2020 tax return paid in 2021. There is no change in that. But I appreciate the questions. One of the things that a lot of people that have stock accounts, especially, and we may see this if we see a dip in any other asset values and other asset classes, excuse me, is we have seen an uptick, and there's been a lot of strategy around people converting their retirement account assets. If you put $100,000 into, just say, the stock market, and I believe it was down about 22-23% as of last look. It really doesn't matter. I'll call it 25 for round numbers. So if you put $100,000 in and you look at your portfolio balance today and it's at 75, and you believe that that what goes down will eventually go up, if you believe that's your best investment opportunity and those stocks, public securities that you own will be worth what they were and then some, it may represent a time, even though there's no tax benefits for you, it still may represent a good time to do a Roth conversion, because the value that you would be taxed on is not the 100 that it was worth, it's the 75 that it's worth today. So if that goes to 100 or 150, you've already paid the tax bill on 75. So something to consider, but there's no CARES Act relief as it relates to Roth conversions. So let's talk about eligibility. Thank you guys for the questions. If you have more, please keep them coming. We're going to wrap up here in just a couple of minutes. But if you are curious if you're eligible for it, here's the requirements. That's why I say it's pretty liberal. Number one, you are diagnosed, right? That's pretty straightforward. So you personally have been diagnosed with an approved test for COVID or a SARS-CoV. Right? If that happens, you will be considered eligible for this loan. The second thing is a spouse or dependent that has been diagnosed. So if I haven't been diagnosed personally, but my spouse has, and I'm the one with the IRA, I'm now eligible. But remember, IRAs are an individual name. So if I'm not the one that's sick or tested, I don't qualify for one, but I may qualify for two. So if a child of mine or anyone that is deemed a dependent to me, including my spouse, is tested positive, then I become eligible, as would she. If my spouse, because she would be eligible under bullet number 1, and I would be eligible to take money out of my IRA under bullet number 2. The one that opens this up for a lot of people, and that genuinely has impacted the most people, is unable to work due to lack of child care. We felt this in our office. I know many of you are feeling this. You guys are, handling the double and triple duties of being home, maybe working from home, and taking care of kids and trying to be teacher. It's a very, very, very difficult time for a lot of people. That is a qualifying act. So in the event that you are staying home or forced to stay home as it relates to child care, it opens up eligibility. And then this is kind of the one, again, that also creates a lot of eligibility for the masses. Experience an adverse financial consequence as a result of being quarantined, furloughed, or laid off, or having work hours reduced as a result of COVID or the SARS-CoV-2. So what that means is, if you're self-employed and you have a financial hardship, regardless of what the job is, I'll give an example. My wife is a photographer, right? So as you can imagine, large gatherings, events, etc., have all been canceled. So her ability to earn a living has been stripped away. So under that, right, my wife would qualify for that. Now, here's the part that is a little uncertain. Do I qualify, right? So if the IRA is in my name, and using the example of my wife having, being unable to work as a result, but my job is still intact, do I qualify? It appears possibly, because obviously we file one return and that's but the IRA is in my name. Just something to be thinking about. Again, there's some stuff that's not 100% crystal clear. You're not proving that to us, you're proving it to the IRS. But just be aware of that. The way that it kind of is worded today would almost suggest, it would suggest it applies universally, but then the way it's specified here, it questions whether or not it applies individually. So make sure that you're kind of looking through that. This is a moot point if any one of the other 3 bullets applies. Right? So as you determine eligibility, make sure that you read this and understand that you do have an eligible opportunity. If you're still gainfully employed, haven't seen a reduction of pay or work hours, if you have a spouse, they're still gainfully employed, nobody's tested positive, no dependents have been sick, tested positive, you don't have school-age children, so you don't have the child care issue. If you don't meet any of those criteria, you don't qualify. And I would be very careful to try to use this as a window to get money out without meeting eligibility, as you don't want the IRS in any way to take issue with that. So I believe I covered all of the items that the CARES Act addresses as it relates to retirement accounts. I'll give maybe just a minute or so, and I'll open up kind of the question box here just in case something new comes in. But one of the things that we're continuing to do is talk to customers and potential customers and educate on, kind of what lies ahead. Nobody has a crystal ball. I think if we did, we'd all probably be a little too scared to actually look into it. But with every sort of life event, and certainly this is probably, in dating in the history books, probably one of the biggest life events, because no matter who or how or what you do or where you live or who you are in the world, you've been impacted. In some way, shape, or form, it has impacted you. Whether it has cost you financial duress or not is to be determined. Whether or not it's caused you medical duress, right, to be determined. But it's impacted all of our lives. The way that we shop, communicate, socialize, and do things in our lives have been altered. Some states, everything's closed. Some states, nothing's closed. It's everybody's approaching this in a lot of different ways. And at the end of the day, nobody's going to be right and nobody's going to be wrong, because we're all trying to figure this out bit by bit, and there is no manual or last time this happened, this is what we did and it worked type approach that can be taken. So, what we're constantly and what I've been really educating the market about is a couple things. Number one, stay safe and vigilant through this process, right? That goes without saying, but whether you think this is a big deal, whether you think it's being blown out of proportion, really doesn't matter. We're all in this together, and we've got to power through whatever that looks like, and control the things that are in our control and let go of the things that are not. But from a financial perspective, there are a lot of things that you can be prepared for, and that is, determining what type of opportunity you think will present itself. Anytime there are markets that are hit hard, and I'm not talking about just stocks, bonds, and mutual funds, but there will be a rippling effect. We have a lot of local businesses that probably won't open their doors back up, or that will be limited, and there's going to be a lot of need for capital to help support a lot of these businesses, and investment opportunities come as a result of that. So while we don't talk about this like, let's celebrate the fact there may be some economic downturn as a result or some economic fallout, we also understand that that happens on a cycle no matter what, and we need to be prepared for that. So, we have a lot of clients that are getting themselves ready in a position to identify buying opportunities and investment opportunities. Regardless of the reason, I would encourage you to be doing that through this process. A lot of our clients have been sitting in cash or moving to cash positions to kind of find the open availability to do that. So just something to put out there. I do have some questions that have come through here. All right, it says, I define a truly self-directed Roth as one where you as the custodian have the ability to disperse $1,000 of my Roth as an option upon assignment, exercise the option. Are you able to do so, or do you require self-directed disbursements to be in a classic stocks? I don't quite understand the context of the question, but if you're asking, can an account with us put an option on a piece of real estate, the answer is absolutely. It is a self-directed account as long as it's not engaged in a prohibited transaction with a disqualified party. Real estate of any type, including options, is stuff our clients do on a daily basis and are currently doing today. It says, I have my own business and have collected a paycheck, but my customers are greatly affected, are buying fewer products from me, and therefore my adjusted gross income will be less this year. Does it seem like I likely qualify for the CRD? My opinion, and remember the first or second slide, I'm not your accountant nor your attorney, but my opinion is yes, you have a clear financial hardship from the shutdown. So, your business has clearly been impacted. So long as you can document that, right? Meaning you can show that, in 2019, I sold $100,000 worth of widgets, and in 2020, I only sold $50,000 worth of widgets, especially if you can show during the month or two or three or however long this last month period the decline in sales as well as future slowdown in sales, then certainly you are financially impacted by COVID and therefore would meet the eligibility requirements under bullet 3, which is having financial hardship as a result. They don't define financial hardship as a percentage, as a dollar. They don't have any income constraints. So they're just saying you have clear, identifiable financial hardship. So without a doubt, this is not a presentation on any of the payroll protection stuff that's going on and some of the small business disaster loan options, but I would encourage you under that scenario, if you have not explored that, talk to your local bank. They're connected through the SBA program, but the payroll protection program has loans that allow you to both access a loan, which may even be completely forgiven if you meet certain criteria and can maintain certain employment. If you don't qualify for that, take a look at some of the disaster loans. The first payroll loan is based off of how much you spend in payroll over a certain period of time, whereas the disaster loans are up to a certain dollar amount as you prove financial hardship. So I would encourage you to take a look at that. We're not experts in that. We're familiar with it, and just being in the business, but that's really something you should be talking with your accountant, or I would recommend whoever you bank with would be a great place to start because these are loans that will be distributed out and dispersed out through the banks, but that's always a great place to go, and I would certainly take a look at that. There's a lot of programs that have been created to provide relief, and it's certainly something that you should take advantage of so long as the need is there, right? If you don't need it, save it for the people that do. But if your business is impacted and you're financially having a hardship, is exactly what the loans are there for. So I would encourage you to look at that. It says, is it mandatory to take money at 70 or is it 72? So originally the RMD requirement was 70.5. That meant if you turned 70.5 in a tax year, that is when you started your RMD. So your first RMD would be due in that tax year, and they gave you a few extra months to pull it out, but it was technically due for that tax year. There was, and the name is escaping me, but there was a tax bill that moved the 70.5 requirement to age 72. So if you turned 70.5 last year, you are on the old 70.5 RMD schedule, and you do have to continue on that process. If you turn 70.5 in 2020, you actually don't start your first RMD till 72. So you're in that group where you actually don't start it till later. Everybody else after you will always begin at 72. So that may impact on whether or not you have an RMD due, and so it's important that you do understand if you had one due in 2020, you don't have to take it. If you had one due in 2019 and it was your first one, you may not have to take it. If you had one, if you're just starting your RMD in 2020 because you reached 72, you don't have one till next year either. It's suspended. So it can be a little bit confusing. There's a lot going on there. Two separate bills that are both colliding in midair. Next question, it says, as of 2020, the age of withdrawing from retirement accounts changed. It now happens by April 1st following the year the account holders reach age 72. So yes, that's what I just mentioned. So the way that RMDs work is a little bit confusing. So your RMD is due in the tax year in which you turn 70.5 pre-2020. So if you turn 70.5 in 2012, your first RMD was due in 2012 and then 13, 14, 15. So you always start your RMD in the tax year in which you become required, which is previously 70.5. If you turn 72 in year 2020, then your RMD starts this year. The first RMD, which is technically that year's RMD, only your first one, they give you till April 1st of the following year. So if I turn 70 and a half in 2019, my 2019 RMD isn't due till April 1st, 2020. But then I would have, CARES Act aside, 2020, if I took my distribution for 2019 April 1st, I would have to take another one by December 31st because that's my 2020 distribution. So 2019's, I got a 3-month extension to April 1st. 2020 is due in the tax year. So you technically, if you delay your RMD for the first year into that 3-month window of the following year, you end up with 2 RMDs in the same tax year for that year. The CARES Act says if you have a distribution due in 2020, you no longer have to take it. So, which is awkward for understanding because technically some people have their 2019 RMD that they haven't taken yet because we haven't reached April 1st. So we technically have now, but this went into effect March 21st. So a little bit of confusion there, but your RMDs are always due in the year in which you turn 70 and a half and beyond. If you turn 70 and a half in 2019 or before, and 72 and beyond if you turn 72 in 2020. Again, 2 separate bills, 2 separate rules colliding in midair. Is this being recorded? Yes. It says, just to clarify, do we have until the end of the year to take the CRD if needed? It appears yes, right? It does not appear like there's a deadline to withdraw it. It will expire at some point. And I think, and the logical reason for that is you may not feel the economic hardship till after the fact. Wonderful. Well, I want to thank you all for joining us today. I hope this answered all your questions without coming across as being, the absolute fact. Please use this information to guide you in your decision-making process, but please don't make decisions without consulting the appropriate professionals that can help you. And please keep an eye out for updated or additional information on any of this stuff. There's a lot of great resources out there, and I would encourage you to continue to stay educated through this process. We wish you and your families all the best through whatever the coming days, weeks, and months look like. Please continue to be safe and vigilant in this process. And if you want to keep getting additional education, we're going to continue to provide as much as we can on what lies ahead in terms of investment opportunities. All of the education will kind of culminate into a big virtual summit we're doing on May the 7th, so more information to come. Keep an eye out for the emails or on our website for logging into that, but it'll be a full-day type summit. I think we have 10 or 15 different speakers on a variety of different investment opportunities that tend to present themselves in times like this. So hopefully that can be of value for you. But we appreciate your business. For those that are clients, we look forward to your business. For those that aren't, we want to thank you all for joining us today. Take care.